everyone, I'm Stan Zaslavsky from Eagle Vision Property, and welcome to another one of our interviews with property development experts. Really excited to introduce to you Ben Payne. Ben is an advisor from Business Concepts Group. He's a CPA and an accountant who has also had a lot of experience in property development himself as a developer. I really wanted to bring him in and have a chat about accounting and structuring for property developments because it's a fairly specialised area. So, welcome Ben.
Thanks, Dan. Property development is a very specialised area. When advisors normally look at property development, I don't think they take into consideration the uniqueness of the type of business transaction it is.
Right.
With property development, your revenues aren't ongoing. Your revenues come at the end of the project. So you've got all these losses that you're generating throughout the course of the development until eventually you settle the properties and actually make a profit.
You hope to make a profit.
Yeah, you hope to, correct. So having those things in mind, what you've got is what we find as well when we've gone and dealt with developers that have come from other accountants is that they get very generalist advice in terms of structuring. So the most common structures that you'll see in development is you'll see companies, unit trusts, family trusts and joint ventures. So they're the four main common ones. But I suppose a lot of the advice that we're seeing coming from other accountants is most of the advice for the structuring side of it is to either structure up as a company or a unit trust for the development, which is not always the right advice, and there's no one shoe fits all approach to development. But what we find with development, because of these losses you are generating over time, is that you need a structure that can actually accommodate that. With your structures such as your family trust, your unit trust and your company, the losses are actually trapped in that entity. They don't flow out to the unit holders or the beneficiaries of those particular trusts. So you need a structure that can accommodate that better. So in our experience in dealing with advisors of developers of all sizes, so from some of Australia's largest developers to developers doing much smaller projects in the background, when they're bringing on investors, you need to have a structure that suits all of those parties involved in the transaction.
Right.
So generally you'll find these days is probably a joint venture is probably the best suited structure for a development. And the reason is that a joint venture is effectively a partnership for tax purposes.
Okay.
And by being a partnership, you're enabling the flow of those losses throughout the years to be able to flow to each one of those joint venture participants, which is really important if you've got other business activities and other revenues you're making from other investments or business or other employment income, that you may have the ability to be able to offset those losses against that other income. And again, so effectively saving you, and potentially could save you a lot of money in tax.
Yes.
We've put together a 1-2 page report so that we can summarise a lot of the concepts that we're talking about here today.
Great.
Just so that they've got something they can take away with them and to get a little bit more understanding about how those structures actually work and how they relate to a property development.
Beautiful. Perfect. Look, thanks so much for joining us. It's all the time that we have for today, and look forward to seeing you again next time.